if the clock started January 1st, some of these stocks look really good.
Yep.
You take a look at their year-to-date performance. Netflix really had a strong quarter. Facebook, take a leap. How do you think things are trending now based on the new data we got in earnings?
Sure. I think the big theme that is coming out of earnings season for me is a focus. We all talk about the growth rate of these companies and of the sector, but margins have actually been the thing that have driven the relative performance in stocks. So if you look at last year, the best performing stock in the group in the large cap, Amazon, had expanding margins. The stocks that kind of had some trouble, like Facebook and Google, had declining margins or pressure on margins. So that was the big theme last year. And actually, I think the reverse is happening this year. A lot of the companies that saw margin contraction last year look like they're set up for margin expansion this year. And inversely, the case as well. The companies like Facebook and Google that saw pressure on margins look like they might have a better expense and margin outlook this year. Last year, that was the way to play the stocks. It's pretty interesting to look at how the tides are turning a little bit. And I think that's a big theme right now is where are we in the investment cycle for these companies? They're all putting up really strong revenue results. Even Facebook, with all the issues that we read about in the press, put up incredibly strong numbers all 4 quarters last year, including 33% revenue growth in Q4 and upside. So I think it's really the margins and expenses, not something we talk a lot about in Internet and FANG, but it actually has been the key determinant in the winners and losers from a stock performance standpoint.
But Mark Kelley, in a way, it seems like investors are shrugging off some of these cost ramps. I mean, if you look at Alphabet, Netflix continues to spend a lot, et cetera. The focus is more on, that 20+% growth at Alphabet for 36 quarters and counting. We should pay attention to that, not the ramping costs.
Sure, no, I think that's fair. But I also think if you look at valuation, Alphabet's still very, very inexpensive relative to its history, relative to peers. So I totally agree with Mark that margins are the story, and it doesn't just, it's not just this year. I think regulation is not the most exciting thing to talk about, but I think that's also an overhang. Are these companies going to have to spend more to make sure that there isn't copyright infringement on their platforms, in addition to all the health initiatives and making sure that, they're set up for future growth, whether
Even
it's CapEx
more because
or
they're
OpEx.
already spending, right?
That's right. And I think, I would say Alphabet, they have YouTube. They've been kind of at the forefront of making sure that that ecosystem is set up well and that they don't have any copyright infringement. You can still find copyright infringement, so there's still a little bit of work to do